Hey everybody, it's Pete Carmesino here at Chaikin Analytics. This is the halftime show here on StockCharts TV. I'm a few days behind. I apologize for that, but I'm going to ask you to go back and look at last week's, the July 24th video. We were talking about defensives and value on the move. Now, I'm not saying I predicted anything, but here's the thing. When trends are changing, you're seeing some things happen. Now, the defensive sector today is also down, so I'm not exactly sure where the rotation is. I can tell you that it's not going toward fixed income with this Fitch downgrade of the U.S. Treasury rating, very similar to about 12 years ago, almost to the day, was August 5th in 2011 when S&P downgraded the U.S. Treasury. And that was due to a debt ceiling, a lot of political footballing there, back and forth. We know that that's continuing, and that's always going to be the case. Just one very important thing. On that Fitch downgrade, it was a downgrade of obviously unsustainable borrowing and things of that nature. You can go read the, it's been talked about ad nauseum. What hasn't been talked about is that they didn't downgrade their country rating. And so although it's S&P now at AA, Fitch at AA, and Moody's still at AAA, there's still some sustainability there to the rating of the country, but not to the rating of the specific bonds. And because of that, we've been talking about bonds. I've been all over the downside of bonds since December of 21, when the Fed is telling you that they're going to raise rates and inflation's getting worse and blah, blah, blah. They flipped from transitory to, obviously inflation being bad. However, my saying is coming true. It's not what the Fed does. It's what they say they're going to do that matters. Okay. Eventually, once they start doing things, they still talk about what they're going to do after they do things. And so if the pace of rates was going higher and the pace of the increases in rates was the highest we've seen maybe in history of the Federal Reserve, and the fact that the market has held up under those circumstances, albeit a very bad or bearish year in 2022, the rebound and retracement this year in mega cap tech and tech in general has been extraordinary. So you can't expect that to continue on and on and on. The fact that Fitch is throwing a curveball here in August, again, around the same time that S&P did this 12 years ago, it's just an interesting setup. And I remember I was trading back then. I was managing money. What happened was, gold rallied. We saw bonds implode. We saw financials kind of roll over. We're not really seeing gold rally. We're seeing gold pull back a little bit. Gold had its rally, and it's not really reacting the way it did. So a lot of folks are saying it's a non-event, no big deal. Other people are saying, like Bill Ackman came out and said he's shorting bonds, probably one of the reasons for the bigger move in TLT today and some of the other bond ETFs out there and the bond market in general. But the case is that it does matter. I mean, it is important, and it is more about sentiment than reality sometimes. And if sentiment is driving one way or one narrative in one direction, it's going to go. And so that's really why we look at trends. And back to the whole idea of defensive last week, I'm just looking at the trend. I wasn't making a market call. I was just saying defensive and value are on the move, right? If it starts to make a move and tech starts to pull back, we just got to be aware of it. So I'm not saying it was a prediction. What I'm saying is that it's sort of just reading the tea leaves and watching, paying attention to what's happening. So in that vein, we're going to talk about the TLT setup. I've been talking about this now for over a year. If you've been following me, we're talking about the downside target in TLT being somewhere between $70 and $80 a share. It's currently trading at around 95. We're below that, around 94, 84. It's down about 2.3% today. That's a pretty big move for that fund. We're going to talk about yield projections on the 10-year, right? They're kind of coming to fruition again. We're going to recap, which we talked about the defensives. I'll look at some of the defensives and the offensive sectors that I consider, it's just three on each side, right? It's utilities, healthcare, and staples on the defense. And I've got, your technology, communications, and discretionary on offense, right? Now, that's just my take on it. You can plug in any other sectors that you think are worthy of being in there or add them to those. But I just look at 3 and 3 just to say, okay, if I can go 3 on 3 here, make it even and see what's happening in those directions. That's kind of the way I look at it. We're going to talk about oil. We're going to talk about the U.S. dollar. We got 2 big announcements tonight, $4 trillion in market cap reporting earnings tonight. Amazon and Apple. We'll just look at the charts. I'm not making any predictions, but we would like to see what's happening ahead of time. And then obviously the last thing I'm going to talk about is Dow Transports. Now, I've been writing about this a couple of times, first time in April. I just did a follow-up article last week about it. And again, it's an interesting setup. It's an old theory. A lot of people call it, sort of antiquated and things of that nature. I like it because, look, if you're ordering things, they got to be delivered typically on rail or airway or, trucking, things of that nature. But in those transports is also a small, little, relatively unknown company called Uber. That was a joke. It's been hitting off 52-week highs. They had great earnings. A lot of people are talking it up. It's a great company. Look, the service is amazing. I haven't been in a taxi since they came out. So let's take a look at some of these charts and kind of see where all of this is heading today. First, we're going to start off with TLT. All right, folks, I start out here. I just want to remind you, you can follow me on Twitter. It's at Pete Carmesino. There's my profile. I put some things out. I got to put a better picture up there. Somebody took a snapshot at one of the panels I was speaking on. That's a view from one of the restaurants in Italy we were in last year, which I miss. But anyway, a little bit about me on there. And then obviously I put out some things about, the downside look, say on Verizon, the upside look here on 3M. We were looking at that around 104. I think that's trading a lot higher. I'm not exactly sure where it went. I think it went over 110, 111. It's pulled back. But, we talk about some things. You might catch some ideas along the way there. But again, just follow me on there at Pete Carmesino. I guess it's not called Twitter anymore. It's called X, right? There's the new logo. So my bad. Although there's still tweets. They haven't come up with a new name there. All right, let's look at TLT. We talked about this. Now, I've been talking about bonds for quite some time. Now, this is a weekly chart, just so you know. That's why it looks like it ends here. So where it began, 2002. That's a long time ago, 21 years. So let's look at what's happening here. We got the 10-year yield kind of pushing higher. We know TLT is going to be universally related to that, right? Because bond prices move yields, folks. That's why. That's why people short bonds, right? Because they think yields are going higher. Well, if you sell bonds, you're pushing yields higher. That's the way it works. So, you've got some support down here. It's pretty low, around the $62 to $63 level. I think it just may get to this peak, which happened in 2008, December of 2008. Now, we know what was happening back then. It wasn't very fun. But that range was resistance until it broke out. Then it became support and moved higher. So I really do think it's going to try to test there. The low that we saw in this particular ETF was, I want to say, right around 89.94. So I'm not really that aggressively far below where it was, but that's going to be significant. It's a very highly followed asset class. Obviously, fixed income is helps us to determine direction in markets and yields and things of that nature. And so we know it affects the tech sector. And one other thing I might look at here is that FANG index. I forgot to mention that in the beginning, because obviously that's going to be impacted. And again, with those earnings from Apple and Amazon tonight, I just don't know how much of a headwind this is going to be, but we do have to kind of be cognizant of it here and watch this. So again, my target of 75 to 80 is still there. I don't deviate from it. I had it on there for a long time. It's taken some time. It retraced all the way back, very long time here. It was up at 160, but we didn't start talking about this really until December of 2021 when it peaked at around 150. It's been down ever since, and the best it's been was about 108. So I call that a little bit of consolidation. I would just watch this. It's breaking now. Anything below this 94.5. I'd say it could be definitely going back to the lows of that 89 and change. So let's see what happens there. So next, I want to look at the 10-year, and I was looking at some projections on the 10-year. Now it's trading at 408. Now I had 4.5 as the projection. I was using Fibonacci. I was looking at just some potential moves percentage-wise. It kind of came up with that range. That was a while ago. Again, when we started to talk about TLT back in December of 2021, all the way back here, we had levels of yields all the way based off of TLT. I think this is basically going to be the same play, the play here, right? If we're looking at a playbook, I think this is the next level. So let's see where it goes. You can see TLT down here on a longer term chart, just trending much lower, again, down to these lows of 89. I think we get there and maybe go lower. So that's kind of what I'm looking at. So let's look at crude, WTI. See, you've seen this chart before. We talked about the White House announcing back in October of 2022, their buy zone of 67 to 72. It certainly has been support. You can't deny it. And if you're looking at it, the way I'm looking at it, it looks to be that, things are heading in that right direction. Now, this could be changing trend here on this on these moving averages, I'm just noticing that it's really sharply moving higher on that 55 EMA. But it's something to be aware of. Look, this creates higher costs. It could be a drag on earnings if expenses move higher. This is an older chart that I had on WTI crude. These are some levels I was looking at, but I really don't see this breaking unless things change in the oil market. But we just got to continue to see how that plays out. All right, I promised to look at the dollar. Here's the USD, dollars on USD here on StockCharts platform here. You can look at that on either the ACP platform or the traditional platform. And I just drew, this is a pretty bad channel, but it's close enough for what we're working on today. You can see these highs really peaking and kind of becoming resistance and falling down. Now, obviously, we talked about rates pausing and bonds sort of stabilizing, but once that changes with that Fitch rating, it kind of decouples some things and messes the trends up. So as rates rise, bond values are falling, obviously, which then pushes up the value of the dollar because it's going to go in the direction of rates, right, opposite bonds. So if we break here on the upside, I would think we would test the highs here at 104. Now, that's the recent high. More recently, see 105. So that range seems normal. Can we get all the way back here? Boy, I hope not. But, it's not impossible. It's just something we got to watch. So we're not really in a situation where we've done that yet, but this has been sort of that 102 level I had as sort of, I guess it was sort of a level where on the candlestick chart, let me just see something here real quick. Yeah, we were kind of bouncing around here. We tested that a few times here. It was resistance and then became support. And that's why I drew that. So we're kind of sitting right, I think almost directly on it, but to the penny. It's kind of weird. But, this is not a live chart, so it's end of day. You have to see where the dollar is going today to kind of see what's happening there. We talked about the transports a little bit. I'm going to jump to that one. I know I talked about that last in the beginning, but it's just basically talking about the Dow Jones transport average, which is part of the Dow theory, and the Dow Jones. Now I added the S&P because things were kind of playing out that way, and you're seeing some recent highs on these indexes. I can actually move that chart up a little bit. I can move that arrow up a little bit. And are we at new highs? Not yet. We were darn close to the index. That high was back here set somewhere in, believe it or not, the end of 2021 when we were talking about rates rising and bond values falling and things of that nature. Now we're seeing that play out again. I don't know if this is going to be sort of resistance. It certainly looks like it at the moment. And for the S&P, it's kind of a different level, but up there around that almost 4,600 level was about where it peaked the last couple of times. Again, just calling it out like I see it, not making predictions here, but that's what I'm seeing here on the charts. So you got to be careful when you see that. Just keep it in perspective. All right, I said we'll look at our defensive sectors and on our offense sectors as well here. So let's look at offense first, right? That's going to be what we know as basically the tech sector. So the first one is the technology ETF, XLK. Second one is discretionary, XLY. The third one is communications, XLC. All very much on an uptrend here from the lows in October, but have certainly retreated slightly, especially discretionary. Obviously, consumer spending could be impacted by higher rates. And obviously, we're talking about student loan repayments kicking in again. And the other thing is, people have been spending, I don't want to say wildly, but certainly aggressively in the last several months with travel. I can tell you, I was traveling and everything was packed. The plane I was on was packed. I was on a train between Baltimore and Philly. That was packed. I was in boating on the Jersey Shore. There were a ton of boats on the water. I was on every form of transportation, including automobiles, and there was traffic on the road too. So when I see that spending sort of potentially peaking, discretionary could be hit. Now, you look at tech here, it's certainly forming what most would consider a bull flag. Don't forget, these are ratios, by the way. I just want to make sure you understand these are ratio charts, not the actual ETFs. But looking at XLK directly, right, it really put in a nice high here, actually a new high, and it is forming a consolidation area. But if it breaks any lower, this could put in a new, a lower low here. We just got to be careful of that. But on the offense, things pulled back. And obviously on the defense, as I said, we'll recap the video from the 24th. we started to see some movement higher, especially on staples. Now, this is the staples ratio versus the SPY. The top one is healthcare, also moving higher. And the bottom one here is utilities, not really playing along. So not all sectors move directly the same, even though they're on defense, but utilities, don't forget, act like bonds. And so if bond prices are retreating because rates are rising or potential issues in that credit market, utilities are going to retreat with bonds. So just be careful when you look at those. The two that are working here look to be staples and healthcare at the moment. Okay, I did something here on the screener on our Chaikin system. All right, we are a 20-factor model, but we also rate ETFs. And just so you understand how the rating works, I'll expand our bar here. So we have a technical rank, and we rank each ETF against every other ETF in the market. Now, I know that doesn't seem fair, but what that means, fixed income gets ranked against tech and vice versa. But here we've got one of the famous ARK funds here, the next generation ARKW, which is really kind of struggling here just a little bit, however, is oversold and everything else looks good. The trend looks strong. Obviously, the relative strength changed a while back here when all markets started to change here back in January, February this year, but had a nice run. But everything looks to be intact. It is oversold, but not really gaining any momentum here. So the other names here have met what we look at as a criteria that we have on our checklist. And all I tried to do is duplicate that here on the ETF screener that we have on our system. And I am catching some ideas here. The Fidelity blue chip ETF, very bullish rating, looking great from a bull to bear ratio. I got 57 bulls, about 16 bears. And again, oversold by. Interesting setup. Excellent looking indicators here. Relative strength is strong. Our rating has stayed bullish the entire time. The momentum is to the upside. The trend is strong. So, and you're oversold here. So again, there are a lot of people talking about opportunities here with downside here in the market. Maybe a small correction could get worse. Just be careful and use your stops. Here's another one, FDN. This is the First Trust Dow Jones Internet Index Fund. Another one, obviously it's mega cap oriented. There's going to be a lot of different cap sizes inside of this ETF. We don't have time to go through every one. But again, just be cognizant that this looks oversold here, but breaking that recent low 167 is not always a great situation. So you got to be careful and look for the next low. Maybe that 157 is a better entry if it gets all the way down there, but stays above that long-term trend. Looking at FINX is the global FinTech ETF, oversold by there. New relative strength change, massive money flow after a really long and drawn out downtrend from the highs of, you guessed it, November 2021, when the dollar started to rise, and obviously rates started to rise too, and bonds started to fall. Some other ones in here on the IPO ETF, it's kind of interesting. So take a look at some of these, go through them, and see if you see any that are in your portfolio or ones that you've been waiting for. But it's hard to be looking at these opportunities way up top here. I'm just saying some of these look good on a trend change, and others look good on a continuation of stronger trends higher. All right, this is a list I like to keep, but I haven't viewed this list publicly in front of on a recording in a very long time. And all I'm doing is looking at just different parts of the market. So here's your high yield bond index. Now this has been in a downtrend, and just remember that we rate these ETFs and rank them against the SPY. So I am obviously looking for this particular ETF to perform in line or better, but I'm not seeing that. Even though I have a bullish rating, that relative strength is just not as strong as I'd like it to be. On the other hand, transports, we were just looking at the index. Here's the ETF that represents that index, new highs, and has really started that trend change all the way back here in June 27th of 2023. Really not that long. It feels like years, but it's only been months. And that run higher was pretty tremendous. Now look at Qs, QQQ, getting an oversold buy here, even though it is tech heavy and we're talking about this bond situation, all this stuff happening with rates, which could become a headwind if it's persistently higher, meaning that if rates move higher just in the markets, forget about the Fed, the market's doing the Fed's work sometimes. And that could be because, again, that Fitch downgrade. But on the Qs, you're looking at higher potential levels on an oversold buy, but you just got to be careful. Make sure that relative strength doesn't change in the interim. Now, what about small caps? Small caps have had a nice run here, but yet they're not on a relative strength breakout. They're the most susceptible to higher rates. And so this one, I think I'd be very careful of. Just watch it, try to find better entry points if you want to be long. But I would say to you that if rates are going to be any higher than they are today, and if they're going to persistently stay high, this could still be in that range like it's been for the last year or so. Just, again, just watch out. And here's TLT. We looked at it before. We'll look at it again. Here's those lows. You're looking at gaps that need to be filled. It looks like one was filled today, right? And there could be, well, it looks like they're all filled. Now, the next level would be that low of around what we talked about, where the print was about 89 and change on one of those days where it printed on the low. But I would think it's going to get there and test and probably move higher. All right, let's look at Amazon, AMZN. Okay, so everything is set up in Amazon. It has been, but we've got earnings tonight, and I would think you really have to be careful. Look at the valuation of this name. It's over $1 trillion market cap. As I said, 1.3 trillion or so. An amazing PE. It's pretty high, folks. You got to be careful. The valuations are really have a lot of people scratching their heads here. But there are some people looking at a potential trade here. I never like to trade before earnings, but it's worth looking at. And here's what I say. I look at this as sort of a way to test what we're seeing. So we got a strong trend, a strong industry. We don't see heavy money flow here, but we do see relative strength being tremendously strong. And it certainly is oversold with our oversold indicator kind of creeping higher. So I do like that. The rating stayed firm as well on bullish. So let's see what happens tonight with Amazon. And the next one is Apple. Always a fan favorite here. And certainly in the markets, there's a $3 trillion market cap. So together they're 4.3 trillion in market cap. Incredible revenue. Same setup, really. Money flow dwindled a little bit toward the highs, but the money flow was strong all the way up. Relative strength is strong, and the rating has stayed bullish. Again, we'll watch this as something that we can continue to see or use in the future. But again, I don't like trading into earnings. I just wanted to call them out because I know it's going to be headline news tomorrow. So let's see what happens, and we'll review these next week on the next video. All right, everybody, that was a mouthful. I really appreciate StockCharts TV and StockCharts.com helping me out here with these videos. I know that was long-winded, but I'll tell you what, there was so much to talk about, from rates, from the Fitch downgrade, from mega cap big names coming out tonight. We got a lot of moving parts, and don't forget, tomorrow is going to be non-farm payroll. So there's no rest, no sleep here, and no rest here for everybody that's in the market. So just pay attention to what's going on, be careful, and we'll be back on Monday with a review of what happened tonight and tomorrow, and what to look forward going forward. So follow me on Twitter, give me a like on the bottom. I really appreciate it, folks. Thanks. Take care. We'll see you soon.